Ladies and gentlemen, please welcome to the stage senior producer and presenter for Al Arabiya News, Naser Tibi, and his panelists.
Assalamu alaikum. Good morning, ladies and gentlemen. Thank you all for being here. The world is experiencing a great transformation on many fronts. These structural changes in the global economy will necessitate a change in how investment strategies are devised and applied. Low growth environment with interest rates staying lower for longer than anyone thought it might be makes capital allocations a real issue for investors. But most investors try to time the cycle, whereas strategic investors are in it for the next 20 or 30 years. Here steps in the sovereign wealth funds with their massive firepower of patient capital, moving away from fixed income, lured into the world of illiquid alternative investments in their quest for higher yields. They are ditching listed companies in public markets where liquidity has been dwindling for the promised handsome returns of venture capital and private equity. Where long-term investing offers sovereign wealth funds the ability to diversify into illiquid assets and earn the additional premium for doing so. But how are sovereign wealth funds evolving? Why are they changing? What impact will they have on the future of investment? And will they play a leadership role in sustainability efforts? With me on this panel trying to answer these questions, Mr. Khalid Al-Rumaihi, CEO of Mumtalakat, Mr. Farouk Bastaki, Managing Director of the Kuwait Investment Authority, Mr. Heenam Choi, President and CEO of Korea Investment Corporation, Mr. Bing Hu, the co-CEO of the Russia-China Investment Fund, and Mr. Ken Costa, the UK Prime Minister's Special Representative for Vision 2030. Boris Johnson's representative, I believe. Is he still the Prime Minister?
He's the Prime Minister.
So many developments in the UK. Can't get my head around it.
He'll be there for a long time.
Yeah, all right. All right, so let me start with Mr. Bastaki. The sovereign wealth funds are becoming more active rather than the passive investors they have been in the past. What is driving this transformation?
Hello. As long as KIA is concerned, we have both. We have active and passive portfolios that in the public market. Regarding the alternative investment is nothing new. We've been doing it for 35 years. We started our first fund, I think, in 1984. Of course, you're not concerned too much about the liquidity as a sovereign wealth fund, and you have as you mentioned, all the time in the world. So it was a good idea to get some extra return by doing that. We're not doing much of a venture. We do buyout, we do mid-market, and we do some venture. So it's a mixture of everything there, credit funds, and so we put in same kind of money every year in different vintages, and with different people, so we're very diversified. Looking for some extra return there.
Everyone's looking for that return these days. Mr. Costa, how sovereign wealth funds are becoming more active, particularly in the alternative investment space?
Well, I think I've had the privilege of being able to see and work with sovereign wealth funds the last 20, 25 years. And clearly, as the markets are shrinking with the US market, the buybacks, the buyouts that have taken place, it's almost as if the world as a whole, investment as a whole, have been forced into looking at the alternative markets. And the way in which sovereign wealth funds have actually approached this has been, of course, very refreshing, because their numbers, the absolute amount of money available for investment, has significantly increased. And we would estimate at the moment that it's something of the order of 15 to 20% that has now moved into the alternative space, whether that's directly or indirectly. And the interesting part of it is that permanent capital is the one great advantage that the sovereign wealth funds have, and the ability to be able to deploy these, whether, again, as I say, directly or indirectly, has actually been there to enhance the returns. And I think this trend will continue, and innovation is going to be required in that sector, but the move towards alternatives will become a greater proportion of the portfolios of sovereign wealth funds, as indeed I expect it to be of the major investment management companies in the world.
Mr. Choi, Mr. Costa thinks this trend will continue. Do you think more funds will be allocated by sovereign wealth funds into the alternative space more and more moving into the future?
Yes, I fully agree with Ken's point. Given such a sluggish, high growth of the traditional asset, we might see some kind of new cycle. I mean downtrend cycle. So now it's time to prepare, to avoid hedge the risk from the traditional assets. So we think that the alternative investment is another source of returns. So KI's case, our end of last year, our portion of portfolio of alternative investment around 16%, but we plan to increase our portion, alternative investment portion, up to 20% by 2021. So even though it's a slow growth, but we care about some kind of vintage risk. So we evenly deploy our capital into alternative asset. Also, we care about kind of hoarding behavior. When there is something good source of investment, many sovereign wealth funds tend to move together. Then eventually there is go to some high risk on that project. So that is 2 points we care about when you increase our alternative investment.
Mr. Khalid, how would expanding alternative investing impact the way sovereign wealth funds operate and the risk that they undertake? What are the implications?
Well, I think, first of all, we use this title of sovereign wealth funds, and it's not all sovereign wealth funds are alike. So I would just differentiate between sovereign funds that are almost private equity funds in the way that they were first commenced operations. So we look at sovereign funds like Temasek, Khazana, Mubadala, Mumtalakat is one of them, that owned strategic assets of the state and that operated like a private equity player in the way that they operated these assets, because they were given these assets to extract more value. So they're going to be more comfortable with alternative investments. They're going to be more comfortable with private equity and venture capital because it's the mindset that they have. But even other sovereign funds, ones like Arabiya, GIC, more of an endowment type mandate, have been more comfortable with private equity because it's generated alpha beyond public markets or public equities and bonds. And so, I mean, as Farouk mentioned, this is not new to sovereign funds. They have been doing this for many, many years. Now, what does it do as they increase their allocation to alternative investments? Number one, it depends on the manager you choose. I think we always see that private equity is dictated by the partner that you choose and the valuation that you enter into private equity at. And so private equity is evaluated in vintage years. If you enter into private equity with the right manager and with the right vintage year, then you can achieve outsized returns. I think what we're going to see is obviously more comfort with illiquidity, but that's not new to sovereign wealth funds. They don't need liquidity. I think we're going to see enhanced returns. And I think we're going to see another trend, we're seeing this more and more, is that investors and sovereign funds will start to take direct equity stakes. They'll dip their toes in private equity or alternatives going through a manager, but you're going to see them take direct stakes in international companies where they sit on the board. They act even more like a private equity manager. And I think we're going to see more and more of a trend in that direction.
And we'll be talking more about whether the right approach is a direct investment or investing alongside someone else. But I would like to ask Mr. Hu, so the RCIF, this is a joint platform between the Russia Direct Investment Fund, CIC in China as well, and even the PIF is maybe contemplating or considering putting in an investment with you guys. What are the benefits of forming joint investment platforms for sovereign wealth funds that could be reaped by the anchor investors? What do such platforms provide to those investors, the founding partners, that they can't do on their own?
Yes, actually we talk about the joint platform between two large institutions. The benefit, I think, is it institutionalized the cooperation between the two large institutions, or potentially could be three large institutions. What I mean by that is not only you have each other as the partners in the different local market, but you have an enhanced version of rep office in the local market. So the partners of ICIF can use ICIF as their rep office in China. And when they need to do due diligence on some of the projects, instead of hiring like a third-party institutions like consultants paying a big fee, they can talk to us. Maybe we just make a couple of phone calls. We can help them solve the problem. Secondly, we can also help them identify the best deal in the market. In terms of the deal sourcing, we, as a subsidiary of CIC, has most of the access in the market. Most of the leading investor, doesn't matter if it's venture capital firm or private equity firm in China, they always respect us as an institutional investor. When we knock at the door asking for an allocation of a hot deal, they will give to us. On the other side, when we come to Russia, when we look at the projects in Russia, our partner IDIF will tell us, the background of the potential targets we're trying to invest, and give us a very good, solid background about the company. I remember there was one time during year of 2014, we tried to invest in an e-commerce company in Russia. Our partner told me that the founder is not that good. And we told our partners in China we are supposed to co-invest. And at that last minute, we decided, we almost signed the deal, but when our partner gave us the concrete evidence about the background, we decided to pull off the deal.
Yes.
And 1 month later, the company showed big problem. So it's really helpful for both. You have this kind of joint platform, you can help us each other a lot, and it's an institutionalized cooperation relationship.
Mr. Choi, in the private equity market, opportunities are often seized by investing early and in small and upcoming firms with high growth potential. Mm-hmm. To succeed, one will need access and to time the execution. Yep. Can sovereign wealth funds realize these fundamentals with their current capabilities and available skill sets?
Yeah, actually, we started our venture investment 5 years ago. It was a new market for us. But in the beginning, as we just mentioned, we have no capacity, so we have no idea. So we started with partnering with external manager. But from this year, we started to do our venture investment program in order to make a direct investment. So even though it's a step-by-step approach, but that could enhance our capacity and capability in investing small, startup company. So by doing this, we realized that important one is that to assess the viability of the program, how it can scale up. That is very important. Second one is that to make appropriate and make a right timing, we need to streamline the decision making process. Otherwise, it takes a long time. So it's quite important to make right decision making.
I want to go back to you, Mr. Hu. Some believe there's a higher probability of underperformance in larger ticket sizes in private equity. Would that drive sovereign wealth funds into a higher number of transactions but smaller ticket sizes, or will that be too cumbersome for large sovereign wealth funds?
I think for sovereign wealth fund, doing the big deals still possible, and you still be able to get high returns. The problem is not about the size. The problem is about the nature of the business and what stage the company is in. For example, 7 years ago, I led an investment of $1 billion in Alibaba. At that time, lots of people are talking about, oh, Alibaba is already a big company, and you probably only get like 1.5 times return when it IPOs. And it turned out we got 5 times return in 2 years. Why is that? Because Alibaba is in a stage of turning point. We see that. We knew that it would be in a trajectory growth period. That's why we made the investment.
And there are a lot of potential Alibabas in China?
Of course, yeah. Lots of our Middle East friends and South African investors, they made good investment, made good money in Tencent. And we also just see recent years, like 5 years ago, I invested in Didi Taxi. Many people investing in it had 5 times return.
Yes.
Not only in China, if we talk about companies in America, for example, Amazon, a very well-known name, IPO'd like in the 1990s, late 1990s, but it entered the trajectory path in the last 5 years. If you invest in Amazon 4 years ago, you probably make 4 times return.
Yes. Mr. Farouk, direct investing is on the rise, and increasingly the most sophisticated sovereign investors invest directly in targets on their own and through co-investment schemes. How would sovereign wealth funds disrupt the PE environment with those types of investments, with those models?
Kuwait Investment Authority, we invest mostly in funds because you have different markets, you have different expertise.
Aren't the fees too high?
Well, the fees is...
Some of the fund managers will like me.
Yeah, well, if you pay 1.5%, it's better than losing half of your money or something. It's like, it depends what is the net return, I think. That will be the question. And everybody you meet, of course, they are top quartile until we find otherwise. But it's, we invest with them, and then we get co-investment opportunity. And then you have like hundreds of funds. So you're receiving 200 different co-investment opportunity every year, and you choose from there. But this one is already, you don't have to have a team that understands the whole world, all type of businesses. So it's for us, it's a better model than investing directly in companies. And it's very difficult, especially when you talk about venture and venture capital, because every company looks very interesting and you think the sky is the limit. And then somebody comes in and they have better technology, half of the price, and it doesn't work. So that's how we do it. But it's been working so far. Different vintages, different managers. It's been good for us.
Mr. Rumaihi, overstretched valuations. Some people are worried about that. They say these overstretched valuations, you can find them in most segments of the market. And there's intense competition for assets driven by the recent trend of mega fundraising. Will it make it difficult to thrive in such an environment, do you think?
Yes. I mean, the worst mistake you can make, even in a good company, is to overpay on entry. And so I do believe that as transactions have more dollars chasing after them, valuations are going to creep up. So I think you have to be very cautious. But then again, there is so much opportunity around the world. And when we look at Mumtalakat, when we look at what is around, we see good value available specifically in sometimes middle market, because you will find these larger funds chasing after bigger transactions. So as you look at middle market companies, again, we like to invest along with a partner. And I think to what Farouk was saying, at times you have to be careful as you invest outside of your territory where you don't know the country, you don't know the nature of the regulation, that you have to do it with a partner. We've done it directly, but with a partner. We just exited an investment in the region, GEMS. We did it with a global private equity player and a regional. We doubled our money in 4 years, high double-digit returns on an IRR basis. So you're able still, I still believe, you're able in the middle market segment to get good returns and not overpay. I think the bigger funds, by nature of them being large, are going to have to chase the larger transactions.
Mr. Costa, is there a role, let's move on to the developmental side here, is there a role or should there be a role for sovereign wealth funds to play in supporting innovation in certain sectors where there is a bit of a risk-averse sense for the private sector?
Well, I think this is one of the great areas that is changing, and many of the sovereign wealth funds, some of which are here, some of which are not, have been trying to find a sweet spot where the risk return is going to be more effective. So rather than to come in at the VC stage, actually in growth capital, which is a growing part of being able to isolate the companies, having gone through the first de-risked period, and then to be able to invest actively and to see those companies growing, has required quite a lot of expertise from the sovereign wealth funds, but also finding the partners, just as Khalid was saying, that the partner matters. And one of the interesting features is as the sovereign wealth funds have grown in the last 10 or so years, so have the family offices, and the ability to be able to structure deals, some of which I have done, where a family comes alongside a sovereign wealth fund to be able to provide the know-how, the expertise, the knowledge of the market, but also to keep it, as it were, in the family sense. That seems to me to be a very important and growing area, as both sides feel very comfortable for the simple reason that they don't constantly have to find an exit, because neither particularly want, particularly long-term families. And we've seen some extraordinary investments in commodities, in tech, in various forms, but particularly in this growth area. And the partnerships between sovereign wealth funds themselves and the sovereign wealth funds with the families is, I think, going to be a continuing feature of the next phase.
Mr. Choi, let's talk about the mandates for sovereign wealth funds. You know, they need to pursue the highest absolute returns, but some of the sovereign wealth funds have a domestic mandate. At KIC, you don't have a domestic mandate, but can sovereign wealth funds juggle both of them?
Yes. Basically, KIC is a official reserve fund, so we manage part of our foreign reserve, so we are not allowed to invest domestically. But by our law, KIC has dual mandate, as just mentioned. The first one is to maximize returns, of course. Second mandate is to contribute to the development of a domestic finance industry. Then question is how. So Korea financial industry more focused on domestic. So KIC can play a role as a facilitator. So, for example, we interest domestic asset managers with the funds so that they can experience overseas investment. The other way to facilitate the Korean financial industry is that since KIC is kind of a front runner in terms of foreign investment, we have some good investment opportunities. In that case, we try to share our investment with domestic institutional investors. That is a way of to help to support Korean financial industry.
Mr. Khalid, is there a risk when sovereign wealth funds invest in their own country that they crowd out the domestic private investors and potentially also limit competition? as the state will always favor the company that already got an investment from the state. What about that crowding out effect, do you think?
Well, I think it's something that you have to look out for, but I always say you shouldn't be investing where there's a crowd. So I think if sovereign wealth funds look at serving a market need and filling a gap where there isn't private investment, and I'll give you examples. We now know that all of the region is looking to create an ecosystem that is technology friendly for startups. We don't find private capital funding, providing venture capital sources of funding for startups. And so we see a lot of sovereign funds now setting up their fund of funds. We in Mumtalakat participate in a $100 million fund of funds for the Kingdom of Bahrain. We see Mubadala doing it now in Abu Dhabi. Same thing is happening in the Kingdom of Saudi Arabia. So this is an uncrowded space. In real estate, if you are seeding investment in an isolated territory, a good example is PIF investing in NEOM, then you are paving the way. Private capital, we have an Arabic saying, Ras al-Mal Jaban. Private capital is not going to go and lead. They will follow, especially in risky, uncharted territories. So I think sovereign funds have to be careful not to invest in crowded territories because that thesis is proven.
So not in shopping malls?
Yes, I would say.
Enough of them, right?
You know, we have enough investment in that. But go into areas, if you want to build a biotech industry, if you want to build a military industry, as the kingdom is doing, then the government has to lead and have the private sector follow. So I think what sovereign funds do that benefits national economies is to go into uncrowded territories.
Mr. Farouk, of course, the biggest risk facing our planet as a whole is climate change. How could sovereign wealth funds integrate financial risks and opportunities related to climate change in their management of these large, long-term asset pools?
Yes.
In a minute, because I think our time is...
I think we're already out of time. Kuwait is a founding member of the One Planet Sovereign Wealth Fund. In 2017, December, we went to Paris with other sovereign wealth fund to develop a certain framework for investing in ESG in a reasonable way. And now we have 6 sovereign wealth funds and 8 asset managers. What we did, we communicated to, we have like 130 different portfolio managers. We communicated the framework to these people. Now what we're doing, we're inviting other people to come in, pension funds, private asset managers. I want to invite my colleagues to join this initiative. And, you know, we're going to be holding the 2020 July, the next One Planet Sovereign Wealth Fund meeting. It will be in Kuwait, while it's like 50 degrees centigrade. So they will discover what we mean by climate change. So this is very important issue to us, and we're talking to a lot of managers, and I see a very good results developing.
Yes.
That's our role.
Mr. Costa, last question of the panel. With the rise of trade wars and economic nationalisms and geopolitical tensions on the one hand, and the less passive roles sovereign wealth funds are playing on the other, do you think sovereign wealth funds run the risk of being seen as political actors and have their legitimacy as institutional investors compromised? Is this a risk on the horizon?
I mean, I don't see it in those terms. It seems to me that every sovereign wealth fund is different. Some have a remit entirely outside of their countries. Some have them in the countries. And for some of them, no names, it is part of the apparatus of the state in the achievement of its own development activities. The best view on this would be that there is a balance to be struck. I think the Public Investment Fund is an example of this, in which the balance of internal investment and external investment is balanced in order to, again, fulfill the clear objectives of the fund and the funding and the charters that set the fund up, rather than the political interference that will always be there wherever you are.
Thank you very much. On that note, we end the sessional. Thank you for you, the audience, and for my esteemed panelists. Thank you all.
Thank you.